Hi everybody, this is Lara with your end of the week video for the trading week ending Friday 16th of August for the S&P 500. I've got 3 wave counts at the daily chart level. I've got 2 short to mid-term bearish counts and 1 bullish count. With the data in hand at the end of the week, a bearish outlook for the short to mid-term is still warranted, but if we see an 80% upward day on Monday, we'll then have 2 back-to-back 80% up days coming within 5 days of a 90% down day. That would be an indication of a 180-degree shift in sentiment from bear to bull, and then the bullish wave count would be the main wave count. So right now, I'm going to be more bearish unless we see that happen on Monday. So Monday will be very important for the outlook for the S&P for next week. The short-term target for a bearish outlook is at 2663, or a more bearish outlook, a zone from 2578 to 2476. A bullish wave count, if we get that 80% up day on Monday, requires price to not move below 2822.12, and the short to mid-term target is 3120. At the weekly chart level, this is my wave count for the S&P. I've also got another count that looks like this, but I've moved everything down 1 degree. Both of them see the bull market beginning in March 2009 as the simplest of all Elliott Wave structures, a 5-wave impulse. I'm labelling that here at cycle degree 1 off to the left of the chart, 2, 3, 4, and now 5 unfolding. Elliott Wave is fractal, and for all of your wave counts at all time frames, you have to fit them into the bigger picture 1 frame up. So this weekly chart has to fit into the monthly chart, has to fit into quarterly charts. It has to all make sense, like a series of Russian dolls stacked inside each other. My monthly charts I link to at the beginning every day of my text articles, and my grand super cycle analysis is also linked to at the beginning of every analysis, and that looks at the biggest picture of grand super cycle wave 1. Within grand super cycle 1, I am seeing super cycle wave 5 beginning in March 2009, so the entirety of this bull market is super cycle wave 5. And for this count, it's nearing an end, with the final 5th wave at cycle degree beginning here, most likely to unfold as an impulse 1, 2, 3, 4, 5 at primary degree. Within super cycle 5, cycle 3 is a little bit, well, not a little bit, a reasonable amount shorter than equality in length with cycle 1. This is the simplest Elliott wave structure, a 5-wave impulse, and one of those core Elliott wave rules states that this 3rd wave may not be the shortest out of 1, 3, and 5, which we call actionary waves. Because 3 is shorter than 1, that means that 5 is limited to no longer than equality in length with 3, so that core rule is met. Now within the final 5th wave, 2 may not move beyond the start of 1, 3 must move beyond the end of 1, and then 4 must unfold and remain above wave 1 price territory to meet those core Elliott wave rules if this is an impulse. This channel is really important, and it gives a strong indication that the way I've got cycle waves 1, 2, 3 and 4 labelled are correct. This channel is drawn with the first trend line drawn from the end of cycle 1, which is in November 2014, I believe, to the end of cycle 3 here, and then a parallel copy is placed on the end of 2. It looks like the channel is drawn from this low to this low with a copy placed up on here. That's actually not the case. It's drawn from another high off to the left of the chart to this with a copy placed on this, and when you do so, it absolutely perfectly shows where 4 found final support. That is a really strong indicator that this channel is correct, which means 1, 2, 3 and 4 are drawn in the correct spots, which means that 5 begins here, and also that 3 was shorter than 1 and the limit applies. This lower edge of the channel, if the current pullback continues and is quite deep, should provide final, very strong support. 2 may not move beyond the start of 1. The daily chart goes from the low here, this point here. This wave count looks at cycle 5 as an impulse with primary 1 over here, primary 2 still to complete, and then we need 3, 4, 5. The structure here of primary 2 is an expanded flat correction. They subdivide 3, 3, 5. Intermediate B is a 1.33 length of intermediate A. The common range for B waves within flats is from 1 to 1.38 the length of the A waves, and so this is within the most common range. And expanded flats are reasonably common structures. C needs to move below the end of A to avoid a truncation and a very rare running flat. The target would see that achieved. The target is calculated using the most common Fibonacci ratio between A and C. C needs to subdivide as a 5-wave structure, most likely an impulse, and it looks like that is what may be happening. 1, 2, 3, 4, 5. At the hourly chart level, here is the end of 1, 2, we need to see 3, 4, 5 to complete C. 3 beginning here may have 1 and 2 may complete early on Monday, close to the 0.618 Fibonacci ratio of 1, but it can't move beyond the start of 1. And then we'd need to see 3, 4, 5 to complete minor 3. At the daily chart level, this is another idea. It's absolutely identical to that first chart up to this low here, and now instead of primary 1 being over here, what if primary 1 was over here and it's a zigzag? That would fit if cycle wave 5 is an ending diagonal. My first daily chart looks at cycle wave 5 as a simple 5-wave impulse. The second daily chart looks at cycle wave 5 as an ending diagonal. Within an ending diagonal, all subwaves 1, 2, 3, 4 and 5 must subdivide as simple zigzags. 2 may not move beyond the start of 1. 2 and 4 within diagonals are usually very deep, and the common range is from 0.66 to 0.81 the length of 1 for 2, giving us this common range for C to end down in here. 2 must subdivide as a zigzag, 5, 3, 5. If it got as low as this trend line copied over from the weekly and monthly charts, it should find very, very strong support there and end if it does come to touch that line. 2 may not move beyond the start of 1. The overall bullish outlook and new all-time highs, once 2 is done, we need 3, 4, 5 still remains the same. The limit remains the same. It's just the structure of cycle 5 is different for this wave count. Alternatively, it's all the same to this point here, and now I'm still seeing 1 over here, but instead of seeing 2 for my first daily chart was A, B, C to continue lower, what if it was over here? This is a much more bullish wave count, and if we get an 80% upward day on Monday, this will be the main wave count again. It's still possible cycle 5 is unfolding as an impulse at primary degree 1, 2, we need 3 to complete, and then 4, and then 5. Within 3, intermediate 1 and 2 could be complete, and then we need 3, 4, and 5. Each of these third waves must be simple impulses, meeting all of those core Elliott wave rules. If 2 is over here, then within 3, no second wave correction may move beyond its start, below the invalidation point. The target for intermediate 3 is for it to reach equality in length with intermediate 1 because it fits with the higher target. For primary 3 to reach equality in length with primary 1 because it fits with the limit for cycle wave 5. At the weekly chart level, this is the second wave count. It is, with one exception, identical to that first weekly chart, but I've moved everything down 1 degree. I'm just really going to quickly go back to that first chart, try and show you what I've done. Instead of labeling super cycle 5 as within its fifth wave, if we move the whole of the bull market from March 2009 all down 1 degree, instead of supercycle wave 5 nearly coming to an end in coming weeks and months, we could just be looking at the end of a first wave within supercycle wave 5. Now, it would be a really long, extended first wave, longer than 7 years. That's okay. Those guidelines of how long the waves should last really should be applied with a reasonable amount of flexibility, because when waves extend, they do so in time as well as price, and not all waves can be extended, so some will be extended and some will be much more brief, hence the flexibility required. If this is just the end of a first wave, then it may be followed only by a relatively brief bear market, maybe to not much more than meet the technical requirement of a 20% correction in price, and after that, a continuation of the bull market for years to come, and possibly even another decade or more, with interruptions by big corrections, which may technically meet the definition of bear markets. So the overall secular bull market may not be about to end. It could continue for many years yet. The difference between those two ideas is probably best viewed on monthly charts. Okay, let's have a look at classic technical analysis for the week. At this last all-time high, at the weekly chart level, there was a strong bearish engulfing candlestick. We've got some more downward movement, and so the bearish implications of that reversal pattern could now be resolved, and now we've got a couple of long lower wicks on the last two weekly candlesticks. Now we have a bullish implication. Look out for resistance next above 2940. The last week here was a downward week. The balance of volume was down, but the candlestick was green. A little bit of support from volume pushing price lower. This week, an upward week, a slight decline in volume. That's not of a concern though, because this market has been rising, often with light and declining volume, and that can go on for weeks or months. If you look at volume at the monthly chart level, it's actually quite stark. On balance, volume is at support. This may assist to halt a fall in price. That, in conjunction with the bullish candlestick wicks, may actually offer a little bit of support to that bullish wave count this week. Keep that in mind. Take it seriously. RSI is neutral. There is room for price to rise or fall. There is still this longer term bearish divergence. That doesn't mean we have to get a deeper pullback here, and this can develop further, or it could actually just disappear. ADX is declining. The DX trend lines have been whipsawing at this time frame. There is no clear trend. MACD gives us a bearish crossover. That too can whipsaw, but with the data in hand at the end of the week, there is a bearish crossover that would tend to support one of the bearish wave counts, but I give this particular indicator one of the lowest weights. At the daily chart level, it's when the S&P has a strong downward movement, it's normal to see 90% downward days, and you can see a few of them. Here we've got one here, and now we've got another one here. We haven't got a new low this week. Price has not managed to close below and make another low. So we don't have a continuation of lower highs and lower lows. We've got a slightly higher high and an ever so slightly higher low. When we see one or more 90% downward days, we should expect to probably see more, unless and until they are followed within 5 sessions by either a 90% upward day or 2 back-to-back 80% upward days. I'm going to see this as an 80% upward day because it's falling short of the 90% upward day at only 88%. But this is a strong upward day, and so that's why I say if Monday completes an 80% or better upward day, we would see the conditions required to be evidence of a 180-degree shift in sentiment from down to up, and we can have a bullish outlook. However, with the data in hand at this time, we do not have that evidence. We should have a more bearish view as dominant at this time. Volume for Friday did not support upward movement, but again, that's in current market conditions for a long time now not been of a concern. Next support about 2800, support below that identified with horizontal lines on the charts. ADX is declining at this time frame after telling us there was a downward trend. It's interrupted. At this stage there is no clear trend. ATR was increasing as price was falling, absolutely normal behaviour for this market. We have a very weak bullish signal from on-balance volume. This signal is weak because the trend line was only just able to be drawn and it has some slope and it's quite short, but it is a bullish signal, would support the idea of at least a short-term bullish outlook, but this is very weak. RSI is neutral, room for price to rise or fall. MACD full bore bearish. Stochastics again entering oversold. The AD line, the weekly chart level, gives us no signal this week. A very slightly upward week, a very slight increase in breadth, supporting that slight rise in price. No new short-term divergence either way. But at the daily chart level, there's a little bit of bullish divergence. The AD line has made a new short-term swing high. Price has not. I read the AD line as a leading indicator, and this would support a bullish outlook in the alternate bullish wave count. At the weekly chart level, inverted VIX has declined this week, but price has actually moved higher, although the candlestick has closed red, so this is not a very clearly upward week. Technically an upward week, yes, but within the week quite a lot of downward movement. That downward movement within the week has support from VIX moving strongly higher. Inverted VIX moved lower, and so this divergence for the short term is bearish. But because this is contradicted by the AD line, I'm not going to give this much weight in this analysis. At the short-term picture between price and inverted VIX, there is no new short-term divergence. That's all for me this week with your S&P analysis. I hope all our members are having an awesome weekend.